Hello, my name is Maria Bezubova and you're at my channel Fertilizers Jazz. Here we talk about events, trends, technologies in the world of fertilizers and agriculture. Please subscribe to the channel, put like to this video, and let's jazz! Today is April 22 and this is a weekly markets update. Let's have a look at the news of week 16 and see what are the next trends. Happy Easter to everyone who celebrates, and let it bring peace to the whole globe. Situation in the urea market was very shaky. After weak results of the Indian tender, APL several times prolonged timing of the final confirmation, however, was able to secure only 883,000 tons. Almost 700,000 tons will be heading to the East Coast, which is actually the target set by the government before the tender. But West Coast will receive only minimal 219,000 tons, which is only 1/4 of the initial target. The market expects the next tender to be announced somewhere mid to end May, with shipment window most likely June-July. For now, Indian stocks look quite healthy, so India doesn't need to rush for the next tender immediately. But these stocks will be depleted very quickly as soon as the season will start in June, and monsoon is expected to be very good this year. In Egypt, there were quite a lot of sales conducted during the week. At the beginning of the week, prices were hovering around $375 to $80 FOB, while closer to the weekend increased to high 380s. In general, the sentiment is quite dull because European demand vanishes and FCA prices across European markets drop pretty fast. However, Egyptian producers guaranteed significant amount of sales for May shipment, which takes stress from their shoulders for now at least. In the Black Sea, there are only small amounts of Uzbek urea proposed at the level of 380 FOB, because Garabagaz is still out of operation and Sokar will have its next tender for May loading only. Turkey is waiting for Iranian suppliers to drop prices more. With current price of $380 CFR duty unpaid, Iranian product is not competitive with Egyptian urea. Iranian producers were not able to close any sales tender at target $350 FOB price, so several tenders were scrapped. Lord Dagan retendered and rumors put the lowest offers this time at $340 CFR. This level is closer to the workable level for Turkish market. In the Middle East, price level was supported by demand from Australia. Two 30,000 tons lots were sold at 390 and even higher level. However, further strong imports from Australia is under question because domestic stocks are full and rainfalls still haven't arrived. January-February import volumes were much higher versus previous years. So, if rains don't arrive in upcoming months, there might be no more need in imports at all. With weak results of the Indian tender and subdued demand from Brazil, Middle East producers will struggle to find support for second half May and June volumes. Also, interestingly, Middle East price level stays disproportionately high versus Egypt FOB. In Southeast Asia, Indonesian pupuk closed several tenders for prilled product at $390 to $96 FOB. Regional market players anticipate demand from Thailand to come back after national holidays. And US, again, is the only market where prices increased last week. This happened due to tightening of supply because of tariffs hassle. Prices surged by $5 to the level $398 to $422 FOB per short ton. General expectation from US traders is that the country will struggle to attract all volumes needed for May shipment. Current lineups already show stagnation signs. In Brazil, the buyers are reluctant to bid for more than 375 CFR max, but there was information about a deal concluded at $5 higher than that. In general, Brazilian demand is still at least a month from now to emerge. Paper values fluctuated differently for different benchmarks. Egypt FOB future price remained unchanged for April and May and corrected upwards by $5 for June. Arab Gulf FOB future price corrected upward for both May by $15 and June by $5, mostly on the back of last week's sales in 390s level. Brazil CFR remained unchanged for all 3 months amid subdued activity. NOLA values corrected downwards for April and May after the spike last week. The spread became less extreme. However, for June, the expectations moved up by $10 to the average of $365 due to uncertainty with imports in May. In ammonium sulfate market, prices in China increased last week due to tightening supply. The problem is in caprolactam production, which is decreasing due to tariffs to US and respective demand decrease for end products from caprolactam. Thus, sulfate production, which is a subproduct, decreases as well. Current price level at FOB China is indicated around $150 to $55. Compacted amsul price also increased to $160 to $70 FOB level. Demand in key markets is very limited, only bits and pieces. In Brazil, there were no deals heard due to significant spread between bids and offers, and in general, demand finalization. The nitrates market is subdued because demand in European markets already finished, while massive Brazilian demand hasn't started yet. Egyptian NCIC has awarded the tender for 10,000 tons of CAN at $280 FOB for Spanish market. Some demand still exists in the African markets, like Kenya, but it will also finish soon. Brazilian ammonium nitrate purchases are on hold because the buyers delay purchases to May and later, expecting lower prices. Recent sales of Russian nitrate to the Latin America was registered at $215 to $20 FOB, about $10 lower versus previous levels. In the UAN segment, main activity was again happening in the US market. The availability is extremely tight, both in the ports and in the river system. Thus, barge price increased by $8 to $10. Most proposals now are for June and even for July shipments, so anything prompt will cost a fortune. Due to that, affordability continues to slip, which is a great concern for the growers, as corn prices are not increasing at the same pace, for sure. Ammonia market is under pressure, and there is no hope at the horizon as it looks now. The supply is building both east and west of Suez, which seriously weighs on the price level across benchmarks. In the Middle East, spot prices dropped by another $10 to the average of $275 FOB. However, demand remains slow. As of mid-May, Ma'aden will stop one of its units for maintenance for 7 weeks. That will take out about 120,000 tons from the market. But most likely, the effect at price level will be minimal. Prices to Europe also dropped to the level of 440 to 50 CFR on the latest sales from Algeria. Currently, ammonia production in Europe is still unprofitable based on recent gas prices, so ammonia imports will continue. West of Suez, the new low was achieved by sales of US Gulf product to Morocco at $415 CFR, which netbacks to $345 FOB. The prices in US Gulf were falling consistently from December last year, and this is not the end, perhaps. New Gulf Coast ammonia plant that finally shipped its first volume in March seems to experience more problems with startup, and it is unclear when the market will see the next shipment from there. Phosphate prices skyrocketed last week. DAP in India has touched the psychological barrier of $700 CFR. India bought 2 DAP cargoes from Russia at $690 to $700 CFR, and then at the end of the week, market was smashed by the news of OCP sales of 50,000 tons for May loading at $750 to $55 CFR. Pakistan is also heard to have bought at $720 CFR. Ma'aden also increased sharply its FOB price level. The company reported 30,000 tons sales to Southeast Asia at level around 710 CFR, which netbacks to $695 FOB. Tunisian producer also increased offers to $670 FOB. Prices have also firmed in Brazil for MAP. A small Russian cargo was sold at $700 CFR for May loading. Domestic buyers are concerned about quickly increasing global price level and are looking into some prompt purchases to secure volumes for soybean application later in the year. In the US, prices were mostly steady or even slightly decreasing after a surge amid tariffs news. DAP barge for May was traded at $635 to $40 per short ton FOB. Major reason for such price hike was supply tightness due to China being out of the international market. Regarding resuming of Chinese exports, rumors circulate that they could be delayed until mid-May or possible even June. Chinese production capacities are completely occupied with production plan of non-DAP and non-MAP products like various NPs, which will last at least until early part of June. However, afterwards, domestic season will come to the end, thus exports possibility becomes more realistic. Elevated sulfur price is the other important factor of price hike, of course. Another rumor that circulates in about long-awaited India-OCP deal. Some market sources indicate that the deal might be finalized as quarterly supply. The quantities discussed are 840,000 tons of DAP and 360,000 tons of TSP for April-July shipment on formula. There is a buyer's option for another 800,000 tons of DAP and or TSP for August-October shipment on formula. However, all this needs to be confirmed, which is expected soon, maybe next week. Moreover, Indian government is considering additional subsidies for DAP TSP to help offset losses. Maybe the deal and subsidy information will arrive in one package. Let's see. Moving to the fundamentals. European natural gas futures edged up toward 35 euros per megawatt hour, rebounding after last week's fall to a 7-month low. The slight recovery follows broader market optimism after the US temporarily exempted some tech-related Chinese imports, like smartphones and computers, from tariffs, easing recession concerns that had pressured gas prices. Meanwhile, milder and windier weather across Europe is expected to boost gas storage injections and reduce demand from the power sector. On the policy side, EU states agreed to allow flexibility in the bloc's gas storage rules, permitting countries to fall 10 percentage points below the 90% storage target if market conditions are difficult. US natural gas futures fell below $3.3 per MMBTU, their lowest in 2 months, due to rising production and mild weather forecasts. Average gas output so far in April outpaced March monthly record already. Also, warmer than usual temperatures are expected to persist through April 29, reducing heating demand. On the other hand, flows to US LNG export terminals also rose to a record in April, driven by rising volumes to Venture Global's new Plaquemines facility in Louisiana. Agricultural commodities future prices softened. Wheat futures markets ended this shortened holiday week lower. In the US southern plains, persistent dry conditions have triggered red flag warnings in areas like Kansas and the Oklahoma and Texas, where hard red winter wheat is grown. The USDA reported only 47% of the winter wheat crop in good or excellent condition, down from 55% a year ago. Although some rainfall in cropping regions improved soil moisture, it also disrupted planting activities. In the Black Sea region, limited precipitation is expected to reduce soil moisture further, while North-Central Europe saw some rainfall, though more is needed. Global winter wheat supply appears stable, but tight carry-out stocks among key exporters and sluggish demand are capping price gains. Hopes for improved US-China trade relations and commodity fund buying have also lent support to wheat prices. Corn futures hovered close to $4.9 per bushel, holding near their highest level since mid-February. The rally was driven by President Trump's decision to pause some planned tariff hikes, a tighter US supply outlook from the USDA, and a sharply weaker dollar amid escalating US-China trade tensions. Beijing announced it would raise tariffs on all US imports to 125% in response to Trump's move. While in contrast, tariffs from US on other major trading partners, including Mexico and Japan, were lowered to a base rate of 10%, with ongoing negotiations with Tokyo aimed at finalizing a trade agreement. So we will see more price volatility, that's for sure. Soybean futures ticked lower to $10.33 per bushel on Thursday as traders took profits ahead of the long Easter weekend. Market participants are closely watching potential trade developments between the US and China, which could impact soybean exports if negotiations resume. However, analysts noted that much of the trade war's effect has already been priced into the market. A brief wave of optimism followed a Bloomberg report suggesting China may be open to renewed trade talks, but that sentiment faded quickly. Traders remained cautious amid the uncertainty, wary of potential bearish headlines from Washington or Beijing. As a result, soybean prices struggled to find direction, with the market largely in a wait-and-see mode. Moving to the shipping industry. Containerized freight index hovered on the level similar to the week ago. Rates of container shipments from China to the US corrected downwards after the surge in the previous weeks. Trump's decision to exclude from the tariffs certain electronics eased sentiment in the market. The uncertainty regarding the tariff situation will continue weighing on prices in upcoming weeks, as market analysts predict. The Baltic Exchange Dry Index picked up compared to a week ago due to positive vibes across these segments and basins. The Capesize market witnessed an eventful and generally positive week, especially in the Pacific, where increased coal demand from East Australia to China and weather conditions impacting operations in China drove a surge in rates. Activity in the South Atlantic, particularly from Brazil and West Africa to the Far East, also contributed to the positive momentum. Panamax segment also showed stable gains, mostly due to activity in the Atlantic. It was also a positive week for ultra-supermax sector, with stronger rates being achieved in most areas. Positivity returned to the Handysize sector as well as the week progressed, especially in the US Gulf, where markets saw a reduction in tonnage availability. The important news for the shipping industry arrived from the US, where US Trade Representative released final version of tariffs for Chinese-built vessels to enter US ports. The worst-case scenario was not approved. However, the fees are still very substantial. That will negatively impact trade flows into the US and increase shipping costs. That will be charged to the US consumers, of course. For example, the fee for a typical Capesize vessel would be around $3 million. But importantly, the fee will be applied per voyage, not per US port call, meaning that if vessel enters several ports, it will be charged just once. The fees will not apply to Chinese-built vessels that are owned by certain US companies engaged in the voyages less than 2,000 nautical miles, as well as vessels with capacities less than 55,000 tons deadweight or 80,000 tons for bulkers. So it means that most of typical fertilizers carriers might be exempted. Also, vessels operating in the Great Lakes, Caribbean, shipping to and out of US territories, or bulk operators that arrive to the US ports empty would also be exempt. I will assess in more details changes for the shipping industry because of these tariffs, together with Gennady Ivanov, owner of BPG Shipping, next week. So don't miss the jazz. To sum up, urea price is looking for direction, with many factors pulling into different sides across the globe. Demand finalization in Europe and subdued activity in Brazil weighed on prices in Northern Africa, while active sales to Australia supported Middle East price level. US markets still digested tariffs news aftermath, and importers were concerned about possibility to secure volumes needed for the season. Indian IPL finally confirmed only about 900,000 tons purchase, and mostly to the East Coast. So next tender, whenever it appears, most likely mid to end May, might be focused on the West Coast only. Phosphates prices skyrocketed across the benchmarks and hit the psychological threshold of $700, not seen for a long time. Gas price in Europe slightly firmed, but approval of milder regulations regarding injections to the stock eased the sentiment in general. Agricultural commodities future prices mostly hovered on the level similar to the last week or softened slightly, as well as container shipping costs. Bulk shipping activity surged across segments and geographies. At the same time, new regulations regarding Chinese vessels entering US ports will negatively influence imports-exports trade flows, despite final regulation version is milder than the original one. So, let's see what is next around the corner. But it will be already next week. Thank you for watching. Please subscribe to the channel, put like to this video, push the bell in order not to miss any updates, and see you soon!